The covered call strategy is quite a famous strategy that consists in buying 100 shares of a stock and then selling a call against those. It's very often used in a way to generate an extra income, extra cash when the market is going down like we've had since the beginning of 2022. But very often the hard part of this strategy is not necessarily to understand the theory, but rather trying to find the stocks that are fitting this strategy, trying to find the calls that we should sell when we're looking to use the covered call strategy. And if you've been watching my channel for a bit, you know that I'm always on the lookout for new tools, new tips and tricks, new systems, new softwares to try to make all that research process a lot easier and a lot less time consuming basically. That's what we're going to see in this video. We're going to talk about the covered call strategy and how you can find stocks a lot more easily using a screener called Tiblio. But first of all, before we go into the screener, let's do a small recap of the covered call strategy so everyone is on the same page. So as I said, the covered call strategy is a strategy that consists in buying 100 shares and then selling a call against those shares. So what does that mean? Okay, let's put it that way. Let's imagine that you're interested in a stock and you're buying 100 shares, okay? So you bought the 100 shares and luckily for you, the stock is going up, so you're making money, which is very good for you. However, let's imagine for whatever reason, you think that the stock market is going to go down in the next month, or your stock that you bought is going to go down, and you don't want to just sit there and just basically bleeding money over the next month. You'd like to take advantage of that down move. Is it possible? Well, it is possible, because if you do sell a call, well, when you sell a call, you're bearish. You want the stock to go down. So in theory, you could absolutely sell a call on the stock where you had bought shares before. So if there is a down move, if the stock indeed goes down, well, your call is just going to expire worthless and you'll have collected the premium by selling that call and you'll have made money. Everyone's happy. So that's very, very summed up, but that's basically what the covered call strategy is. It's buying 100 shares and then selling a call on the same stock because you think, for example, the stock is going to go down on the short term. That's usually why people are using the covered call strategy as a way to take advantage of a down move when they already have bought shares of a stock. So the good sides of that strategy is that first, you can take advantage of down move while still owning shares. Yes, okay, you'll probably be losing money. Your shares will lose value because the stock is going down, but as you sold the call and you're making money by selling that call, and if the stock goes down, then it's actually quite good for you because you're making money that way. So it's a great way to generate some extra cash. However, if you were wrong, the stock is not going down, but it's actually going up to the moon, as we say, well, in that case, you're going to miss out on a lot of profits than if you had just bought the shares and not sold that call. By selling a call, if the stock goes up, you're going to get into a loss on the call that you sold. Your shares will indeed take value. You will make a profit on your shares, but you will have a loss on the call that you sold. And if your call expires in the money, then you'll have to sell the shares. You'll be assigned, you'll have to sell 100 shares of the stock. And luckily, as you will have already 100 shares of the stock because you previously bought them, then you're going to just resell the shares that you had previously bought. Because when you sell a call, if, for example, let's say you decide to sell a call at that level, but the stock ends up going above your strike price, and your option, your call that you sold expires in the money, then you are being assigned. You have to sell 100 shares of the stock depending on the number of contracts that you sold. And that might be a problem for people that do not want to sell their shares. So you always have to be careful. You have to be willing to potentially give up the shares that you have if you're selling a call against the shares that you own. So just keep that in mind. Covered calls are great if you want to take advantage of down moves. They're really a great strategy because they allow you to generate an extra cash, extra income by selling those options, those calls. However, know that if you're wrong and the stock goes up, you will be limited in terms of profit that you will make because you will get into a loss on the call that you sold. However, one thing that is often misunderstood that I really want to emphasize is that we often think that the covered call strategy is a bearish strategy. Because we sell a call, we might think that, okay, yeah, because we are selling a call when we're using the covered call strategy, it's actually a bearish strategy. We want the stock to go down. It's more a bullish strategy than a bearish strategy because in the end, the risk of that strategy is if the stock goes to zero. Because if the stock, let's say, goes to zero, your shares are going to be worthless. They're going to be worth $0. So even though you'll have made a bit of money on the call that you sold, if the stock really goes down like by a lot, then you'll have lost money on your shares that you had bought. That's why we usually say that the covered call strategy is a bullish strategy and not a bearish strategy. As much as you can make money from calls with the stock going down, we don't want the stock to go down too much, otherwise you're going to be in a really big loss on the shares that you own. To show you a quick example of how it would work in real life, let's imagine that you were willing to trade Apple, okay? Very, very famous stock. Let's imagine that the stock is going up, and then at some point you think the stock potentially is going to go down. So what you can do is that if you had bought, let's say the shares here, you had bought 100 shares of Apple, well, what you can do is sell a call when the stock is over there. So after that, if the stock goes down, your call that you had sold is going to expire worthless. But if the stock continues to go above your strike price for the call that you had sold, you're going to be assigned at this price, and you will basically make the difference between the shares that you had bought and the shares, the point at which you sell them. You will make the difference in profit. So that's pretty interesting also to use the covered call strategy, because if you manage to sell the shares, if you manage to get a sign at a strike price that is higher than what you had bought the shares at, then you're going to make the profit, you're going to make the difference in profit, which is really, really cool, because you don't even mind if the stock, for example, goes above a certain strike price. As long as it's above your entry price, you're going to make the difference in profit. Some tips to really use well the covered call strategy, and trust me, there are a ton of mistakes that you can make, but if you follow those 3 tips, it will probably go a lot better for you. So here's the first one. The first one is about liquidity. So what do I mean when I talk about liquidity? Well, first of all, I talk about the stock. You want to trade, you want to buy shares of a stock that are liquid. And the reason why is that the more liquid the stock is, the tighter the bid ask are going to be. So the easier for you is going to be to get in and get out. But we're also talking about liquidity for the options, for the same reasons for the stock. The more liquid the options are, the tighter the bid asks, and the easier it is going to be for you to get in and get out of a trade without any problem, without giving back profits, without taking a loss. I mean, it's much better for everyone. So first of all, prioritize liquidity. Then we're going to talk about the health of the stock. So this one might look a bit weird, a bit odd at first, but I'm talking about health of the stock in regards to everything around the balance sheet and everything. So I'm not saying that you should do like full-on analysis of all the financial statements of a company. I'm more saying this in terms of if you can avoid meme stocks, basically avoid them. So that's really what I mean. You don't want to go trade stocks that are just meme stocks or that are going to go to the moon one day and then go to zero the next day. One very good example of this is the stock RIDE, R-I-D-E. If you look at this chart, that is basically the archetype of the type of stock that you don't want to trade. You don't want to trade this type of stock because you're going to have like huge headaches. They're going to go to the moon one day, go to zero to the next day. If you go for stocks, for example, let's say like Walmart or stocks like this that are really big, they have a big brand, they have pretty healthy company overall, like you know that you won't have very big surprises one day or the other. You know that the price won't jump from $140 to $1,000 to $50 the next day. And I know that can seem like quite intuitive and can seem logic. However, trust me, not everyone is trading healthy stocks, and that's probably one of the biggest reasons why people are just losing a lot of money, is that they're going for meme stocks where there's just too much volatility. So you want volatility, but you don't want too much of it. The third criteria, and this one is pretty important, especially because you usually realize your mistake only after you made it. It's about the premiums. So what do I mean when I talk about premium? So what I mean is the price of the option, because that premium, the price of the option, it's basically how much you're going to get paid when you're going to sell those calls against the shares that you own. So you want to sell ideally big premiums so you make a lot of money out of the calls that you sell. And very often what will happen, and what I've done myself, I've fallen into this trap also, is that you're going to buy shares of a stock, then you're going to sell a call against those shares so as to do the covered call strategy. However, there's just no premium in this option. So you're not making a lot of return on investment, and it's more time wasted than anything else. For example, if you buy 100 shares and it's worth, let's say, I don't know, $100,000 in total, okay? You bought for $100,000 worth of shares, but the call that you're selling only brings you, let's say, $100 every month. well, you see that is going to be a very, very long way to make any significant return on investment. So that's why you need to also look at the level of premiums and try to sell some expensive options, some expensive calls, so you can make a pretty good return on investment. That's basically the goal. But the question is, how do you know which calls are going to bring you decent return on investments? Because you could go manually and just look at different stocks and look at the different calls to see if they're really worth your time, or you could use a screener. And that's a great transition to talk about Tiblio, because they have a lot of market screeners that I'm going to show you in a minute, where you can see very quickly what is the return on investment on the calls that you like to sell, and plenty of other stuff that I'm going to show you in a minute. So I'm on Tiblio's website. So this website has plenty of features. You can, for example, log in your trade in a trade journal, so you can see how much money you made, what are your returns, what is your winning rate, for example, this type of things. And they also have plenty of different screeners so as to help you when you're using different strategies. So right now we're focusing on the covered calls. So if you look over there, they have a screener for the covered call. And that's really where it's going to get interesting, because you're going to be able to see what are the potential return on investments on different stocks selling some calls, so you can already know in advance if it's actually worth your time, and you should actually use the covered call strategy on this stock. So if we go into it, if we click on it, then you're going to arrive on basically this page where it's going to show you different columns. So at first you have the symbol, you have the different put or call. As we're talking about covered calls, we're only going to focus on calls here. Then you have the expiration, you have the strike, you have the stock price. The estimated credit is how much money you're basically going to get for the calls that you're going to sell. And then you have the percentage return if called. So what that means is basically the return on investment if your call gets assigned. And the most interesting part, obviously, is that you can filter everything by what you want. If you want to, for example, see what are the cheapest stocks first, you can see all the different stocks, or the most expensive. You can see also what is the credit, the biggest credit that you can receive, but also you can see the biggest credit that you could receive. For example, you see that you would basically receive $45 if you were selling a call on the stock Melly at the 1250 strike in the 14th of April expiration. So that would basically mean that you would receive $4,500 worth of credit if you were selling the 1250 call. But also something that I really like, that I think is really the most important, is the percentage return if called. So that's why you can also filter it to have the smallest return on investment first, or the biggest ones. And you're going to see that actually having the biggest return on investment might not be in your favor. The reason is because of the criteria that I just mentioned before in terms of health of the stock and making sure that it's a quality stock that you're trading. So if I was willing to find a stock, for example, for the covered call strategy, how would I proceed for that? Well, personally, I would probably go filter the stock by the stock price, because I like personally to trade stocks that are around the $20, $30 range for the covered call strategy. So let's say that I was filtering by the smallest, and then I try to go a bit forward. I go click on the next page to see what are the different prices for the stock. So you can see that the prices are basically in that column. And if I go on to the next one, I'm going to see what comes up when I get around $20 or something like this. So you see that you start having some stocks, for example, around the $20 level. So for example, NV, AEO, NIO, or for example, something that I really like, a stock that I really like to trade is CLF. So for example, that's interesting. Let's say that you spot a stock that you like within that list. Well, you can dive in a bit more by going into the search bar, and then you're going to type CLF, and you're going to see the highest premiums for that particular stock. So here we can see that they have chosen one where it shows that if you sell the 27 strike in the 14th of April expiration, you're going to collect a credit of 85 cents or $85, which is going to be a return if call of 17%. So that's definitely one way you could find stocks, for example, for the covered call strategy. You could dive in within that market screener and see what are the highest premium for the out the money options, because remember that that screener is only screening for high premium for the out the money calls. So even though, let's say that you were wrong, the stock does not go down, it goes up, by buying the shares at this level, at for example the level that CLF is at, for example, let's say $24 per share, and then you instantly sell the 27 call. If your call expires in the money, you're instantly going not only to make the profit of the call that you're selling, $85, but also you're going to make the difference between what you bought the shares at and what you're selling them at. So in our case, if you buy them at, for example, let's say $24 per share and then you sell them at $27, well, that's a $300 profit on top of the premium that you're selling. So that would be around $385, which almost matches what the return is being shown here. And of course, if you're interested in other strategies, you could always go, for example, in other screeners. For example, there's a short naked put screener that basically goes for the same concept. Is for liquid, for at the money put options paying a high premium. So you can have basically the best return on investments, and you can filter by the max return, the max percentage return, the probability of profit that you can see pop, or for example by the max loss. I mean, that's really interesting because you have a lot more visual way and it's much quicker way to find some trade ideas. One thing that I really do like though as a market screener is the option flow and option sweep screener. So you're going to see what are the top biggest options order that are flowing through the market. And that's really interesting because as much as it's not necessarily going to tell you like which stock is going to become the next GameStop or whatever, that's still a very good indication and it can always give you some interesting information. So the way it works is that you have basically those different filters if you want to focus on calls, puts, vertical spreads, or iron condors. Let's say that we just don't choose anything. If we go down, you're going to see some big orders. That's what this screener is made for. It's showing you exactly what are the big orders that are going to flow within the market. What you see, for example, here is that on Snap, there has been an order to buy the 37 strike puts, and the size of that order is 2,543 contracts, which represents a premium of $184,000. So there's someone that bought 2,500 puts at the 37 strike on Snapchat, paying $184,000 worth of premium. And that type of thing you can see for a lot of stock. For example, there's someone that bought on Intel the 50 call, and they actually bought 1,875 contracts, paying an overall premium of $160,000. That's a really interesting information to know. After that, how do you want to use it? Do you want to make it part of your strategy when you're choosing stocks for example, a cover call strategy? That's completely up to you. But I can always give you some nice information about what is going on for that particular stock. Let's say that we're, for example, focusing on, let's say, Snapchat. You can see all the orders for Snapchat, or we were talking about CLF before. Then you can see all the different orders for CLF. We can see that overall more and more people have been buying puts at the 18 strike, 17 strike, also some iron condors. So I can show you some bigger orders than what we're usually doing as retail traders, like one contract per one contract. If you want to do a trial, they make a trial for 7 days for $1. So if you want to check it out and basically just try the software, you can go in the description. I'll put a link in the description of this video where you can try out the software for $1 for 7 days. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.